So, um, imagine for a second being handed a standard paper punch card, like, the kind you get at your local coffee shop.
Oh, right, where you buy 10 lattes and get the next one free.
Yeah, exactly like that.
Hmm.
But instead of getting a free latte after 10 punches, this card represents literally your entire financial life.
Okay, that sounds stressful already.
Right. And here's a catch. You only get 20 punches. That's 20 major financial decisions for your entire lifetime. Once you make that 20th investment, you're just done forever.
Wow. I mean,
Okay.
if you actually had to operate under those kinds of terrifying constraints, it would it would completely change your behavior today.
It would have to, right?
Yeah, it would fundamentally alter how you view the world because, we're so heavily conditioned by modern culture to believe that extraordinary outcomes require frantic activity or like extraordinary complexity.
Some proprietary secret algorithm or something.
Exactly. We just assume more action equals more results.
But the reality is often the exact opposite. So, welcome to today's deep dive. Our mission today is to unpack a masterclass on capital allocation. It was given in May 2026 by the legendary entrepreneur and investor Mohnish Pabrai.
Yeah, he gave this incredible talk at the University of Nebraska, Omaha, and we're going to extract his core mental models to really help you navigate high uncertainty with extreme confidence.
We're getting into the raw mechanics of how the greatest investors actually think.
Uh-huh.
But because we're talking about high-stakes capital allocation today, before we pull apart the mechanics of how this all works, we do need to lay down some required ground rules for our community.
Right, the housekeeping stuff.
Yeah, just quickly. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. To track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store.
Super useful tools, by the way.
For sure. And also, disclaimer, all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for information and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.
You know that phrase in the disclaimer about differing interpretations? That's actually, it's the perfect launch pad for this material.
Oh, really? How so?
Because how we interpret and combine simple information is basically the entire game. Like Charlie Munger, Warren Buffett's longtime business partner, he built his whole life around this idea of mental models.
Right. The mental model?
Yeah, and specifically, he talked about this thing called the Lollapalooza effect.
Okay, I love that phrase, but it definitely gets thrown around as a buzzword a lot. What is the actual mechanism of a Lollapalooza effect when you put it into practice?
So it's basically the mathematical magic that happens when you overlay 2 or 3 distinct mental models and they start interacting, non-linearly.
Okay, meaning what?
Meaning 1 plus 1 doesn't equal 2 anymore, it equals 11.
Oh, wow, 11.
Right. So, for example, if you combine an extreme understanding of human psychology with a really rigorous grasp of compound interest, they amplify each other. You aren't just adding skills together.
You're like multiplying them.
Exactly. You're creating an entirely new, impenetrable framework. And that gives you this massive advantage over someone who might just be, honestly, naturally smarter than you.
Right. But Pabrai argues there is a massive catch to all of this. He calls it the bedrock model.
The foundation for every other model.
Exactly. And the rule is aggressively simple. You have to take a simple idea, and you have to take it incredibly seriously. Like, if you don't let a concept completely dictate your physical behavior,
Yeah.
just knowing the model is totally useless.
Yeah, which brings us right back to that 20 punch card concept you opened with.
Right, exactly.
So think about the math of a human investing lifetime. Let's say you have maybe 60 to 70 active years to compound your capital.
Okay, makes sense.
If you strictly limit yourself to a 20 punch limit, that forces a radical behavioral shift. I mean, it mathematically mandates that on average, you are only making one major bet every 3 to 5 years.
Which is wild to think about.
Yeah, the guiding principle becomes fast to slow.
Hold on, though. Let's be real about the psychology of that for a second. If I just sit on my hands for 4 entire years between investments, I'm watching the market open every single morning.
Yep, the FOMO is real.
It's intense. I'm watching everyone else make money on daily trends or tech startups or, crypto swings. How is doing absolutely nothing for 4 years not just leaving massive amounts of cash on the table out of sheer stubbornness?
Well, because the cash on the table is largely an illusion.
An illusion.
Yeah, the goal of capital allocation isn't activity. It's accuracy. Patience is actually the ultimate filter against mediocrity.
Oh, but it feels awful in the moment.
Of course it does. The reason sitting on your hands feels like leaving money on the table is because human beings are just wired to crave action. We want to feel like we're steering the ship doing something.
Right, we want to feel productive.
Exactly. But to understand why you would willingly handicap yourself with only 20 decisions, you have to look at the actual historical math of the stock market.
And the numbers are incredibly sobering, honestly. This is what they call the 4% reality.
Yeah, write that down.
So if you look at the last 90 years of U.S. equity markets, only about 4% of publicly traded companies delivered all the wealth creation above Treasury bills.
Just 4%. That is the core mechanism that justifies the boredom right there.
It's crazy.
It is, because 96% of the things you could possibly buy are, over the long run, terrible investments that barely tread water. You are hunting for severe anomalies.
Right. I think John Templeton said the best analysts are wrong a third of the time. But Pabrai argues it's actually much higher than that. Like, you will be wrong up to 50% of the time.
Oh, absolutely. Even Warren Buffett admitted this. Out of the 300 to 400 different investments and key hires he made over his 60-year career, only about 12 ideas actually built Berkshire Hathaway into a $500 billion empire.
Just 12 ideas
Yeah.
out of 400.
Yeah. So if the hunting ground is mathematically that barren, and even the greatest of all time has an astronomical error rate, you cannot survive by trying to look everywhere at once.
You're mathematically forced to shrink your hunting ground.
Exactly, which is the entire premise behind the circle of competence model. And the crucial distinction that people always miss here is that the overall size of your circle doesn't matter one bit.
It doesn't.
Not at all. What dictates your survival is staying relentlessly focused on the absolute epicenter of whatever tiny circle you possess.
Right, right. There's this incredible story Pabrai shares about a friend of Charlie Munger's named John Arriga to illustrate this perfectly.
Out of the real estate guy?
Yeah. This guy started with absolutely nothing and became a billionaire in real estate. But he didn't, build a global empire or anything.
Yeah.
His circle of competence was microscopic.
Very microscopic.
He strictly bought real estate within a 1-mile radius of the Stanford University campus.
A 1-mile radius. That is the ultimate example of the epicenter. I mean, he never ventured into San Francisco, let alone another state.
Yeah, he just stayed put.
But if you walked that specific campus with him, he possessed absolute information supremacy. He knew the history of every single brick, the exact rent of every building.
The plumbing issues, the zoning laws, the transaction history, everything.
Right. And because he knew that tiny area so well, he didn't have to guess. He just waited for economic downturns, waited for an owner inside that 1-mile radius to feel some financial pain. Then he bought the property under-leveraged, and he just held it forever.
But, how do you actually maintain that discipline? If you know the math dictates a massive error rate, how do you resist the urge to step outside your 1-mile radius when everyone else seems to be getting rich on some shiny new trend just 2 miles down the road?
Honestly, you resist it by accepting that ego destroys returns. You just have to kill the desire to be a polymath who knows everything about everything.
That's tough for a lot of smart people.
It is. But if you know a little bit extremely well, you have an asymmetric advantage over the generalist who knows a little about a lot. The generalist is just guessing. The specialist, like Arriga, is executing on absolute certainties.
So if you're deliberately confining yourself to a tiny circle of competence and you know only 4% of ideas are actually winners, how do you actually find them? Because you don't invent them right, you steal them.
Yeah, you leverage the heavy lifting of others.
Right, Pabrai literally calls himself the shameless cloner.
Which is such a great title.
Yeah, it is. He proudly stated at his own annual meeting that he owns 0 original ideas in his portfolio. Not one single original idea. Everything is cloned.
Yeah, he uses free resources, Places like the Value Investors Club or Dataroma, where ideas have already passed through the intense scrutiny of highly intelligent people.
Well, wait, I have to stop you there for a second. Cloning sounds like a very polite word for plagiarism.
I guess you could say that.
We live in a world that completely idolizes original thought and innovation, right? Does straight-up copying someone else's homework actually give you a competitive edge in finance?
Well, see, in art or academia, originality is the ultimate currency. If you plagiarize a novel, you're ruined. But in investing, the market does not pay you a premium for being original. It only pays you for being right.
Oh, good point.
And Pabrai points out that the human brain is a really dangerous place. Coming up with an investment thesis entirely in isolation is perilous because you will naturally fall in love with your own brilliance.
You completely lose your objectivity.
Exactly. But by looking at ideas that have already survived a brutal primary filter, like the stringent requirements to even post an idea on the Value Investors Club, where like 90% of applicants are rejected, you drastically reduce your unforced errors.
Right, you let a room full of obsessed analysts try to poke holes in a thesis first.
Yep. And if the thesis survives their attacks, then you borrow it, verify it yourself, and execute.
And once you've successfully sown a great idea and buy into a phenomenal business, the next mental model is crucial. Do not cut the flowers to water the weeds.
Yes, such a common mistake.
Meaning, don't sell your compounding winners just to buy losing stocks simply because the winners feel a little overpriced today.
It's a major trap. Ben Graham, who heavily influenced Buffett early on, had this classic approach born from the Great Depression. He'd say, buy a dollar for 50 cents, and the second it reaches 90 cents, sell it.
Just flip it.
Right. But if you own a truly exceptional business, the mathematical risk of holding it, even when it's temporarily overpriced, is much lower than constantly playing what Pabrai calls a gin rummy game of discarding and drawing new cards.
Which perfectly tees up the cautionary tale of Nick Sleep. This story completely blew my mind.
Oh, it's wild.
So, Nick Sleep and his partner were managing over $2.5 billion in the UK. They were wildly successful. But the British regulators started breathing down their necks, demanding they diversify their portfolio because it was too concentrated.
Which is standard regulator behavior.
Right. So instead of complying with traditional Wall Street rules, they looked at each other, realized they were already independently wealthy, and simply fired all their clients.
They returned billions of dollars.
They handed back a massive fortune in management fees strictly to avoid the forced mediocrity of diversification.
It is just the ultimate flex of conviction. Sleep took his own personal fortune and consolidated it into just 3 stocks: Amazon, Costco, and Berkshire Hathaway, 1/3 in each.
Unbelievable.
And if he had just walked away and gone to the beach forever, his returns would have been astronomical. But he forgot one specific mathematical model, which is escape velocity.
Escape velocity. Break that down.
So escape velocity is this fascinating mechanical concept. It dictates that once a portfolio is massive enough and a single dominant stock grows to consume the majority of it, the traditional rules of portfolio balancing completely break down. You have essentially escaped the gravity of financial ruin.
But Sleep forgot the math on that. After 2014, Amazon exploded. It compounded so aggressively that it grew to become 80% of his entire net worth.
Which, according to traditional rules, is terrifying.
Exactly, so he trimmed it. He sold half of his massive Amazon position to buy a UK fashion retailer called ASOS, a company that essentially flatlined and went completely nowhere.
He literally cut his biggest flower, his ultimate compounding engine, to water a speculative weed. And this ties directly into a brilliant psychological model Pabrai uses to explain why we make these unforced errors. He calls it the mistress versus wife illusion.
The name is definitely a bit provocative, but the underlying psychology is entirely about information asymmetry, right? It's the idea that the stock you don't own always looks incredibly appealing compared to the stock you actually do own.
Yes, it's the illusion of the unknown.
Yeah.
Think about a company you've owned for 5 years. You know every single operational flaw.
You see all the cracks.
Exactly. You know, the CEO makes bad jokes on the earnings calls. You know their supply chain is a mess in Europe. You know their margins are slipping slightly. You live with all the warts.
The new shiny stock.
Right, the new shiny stock. You haven't done the agonizing due diligence yet. So your brain automatically fills in the blanks with absolute perfection.
That makes so much sense.
The new idea always looks flawless because your ignorance hides its flaws. You have to recognize that psychological trap and stay intensely focused on the businesses you already know are great.
Okay, so let's put this all together so far. You've aggressively conned a great idea. You've ignored the shiny new object. You are holding onto your massive flower. But what happens when the macroeconomic environment collapses and the market crashes 60%? Because a mental model is completely useless if it doesn't account for human panic under extreme stress.
Yeah, and this requires a mechanism to survive what Pabrai calls the deep well.
This was easily the most intense part of his talk. Pabrai tells this deeply personal story about his dad. His father was a brilliant engineer, but a highly aggressive businessman whose companies frequently went bankrupt.
High risk, high reward.
Very high risk.
Yeah.
When Pabrai was around 11 years old, his dad was in the middle of a brutal bankruptcy. They had no money for rent. They could barely afford groceries, just complete financial despair.
He was at the absolute bottom of the well.
Yeah. And every single Sunday, an astrologer dressed in saffron robes would come to their house. Pabrai's dad would scrape together money they desperately needed for food just to pay this astrologer to read his fortune.
Which sounds crazy.
It does. Finally, young Mohnish confronts his dad. He says, "You are a rational engineer. You know this guy is speaking absolute nonsense. Why are we paying him?"
And his dad's response is heartbreaking, but also really profound.
It really is. He says, "I am at the bottom of a very deep well, and I need a rope to climb out. If I pay him, he won't tell me the future is bleak. He will tell me the future is phenomenal, and right now, I need him to tell me that. That hope is my rope."
It's just a stark realization about the limits of human rationality. When the pressure is high enough, pure logic isn't enough to keep you functioning. You need a psychological survival mechanism.
Right. And you see this play out in Pabrai's own life later on.
Exactly. Fast forward to the 2008 and 2009 global financial crisis. Pabrai's own fund gets absolutely hammered, dropping from $600 million down to $200 million.
A 67% wipeout.
Driven entirely by asset values just
Yeah.
plummeting, he realizes he's at the bottom of his own deep well, and the panic is starting to set in. He needs a rope.
And to build that rope, he intentionally violates one of his own cardinal rules. Pabrai has a strict mental model. Thou shalt never use Excel.
Because his logic is that if an investment is so mathematically complicated that you need a complex spreadsheet to justify the return, the thesis is too fragile and you shouldn't buy it.
Right. But to survive the emotional crush of 2008, he fires up Excel anyway. He builds a spreadsheet valuing his portfolio, not at the terrifying, panic daily market price, but at his heavily researched estimate of their intrinsic value.
And we should probably define intrinsic value here for clarity.
Yeah, go ahead.
The market price is just a voting machine driven by whatever mood traders are in today. But intrinsic value is the actual mathematical pile of cash those specific businesses will generate over the next 10 years, discounted back to today.
Right. So he would open that spreadsheet every single morning. He would stare at the intrinsic value calculation just to ground himself in reality and maintain his sanity while the market screamed that the world was ending.
It strongly reminds me of Steve Jobs' famous reality distortion field.
That's a perfect analogy.
Yeah.
But it does raise a dangerous question, right? How do you balance needing a psychological rope to survive tough times with the very real danger of just blindly burying your head in the sand while your financial house actually burns down?
That is the ultimate tightrope walk of investing. The singular difference between a survival rope and complete delusion is the structural soundness of what you are holding.
Okay.
Pabrai's spreadsheet only worked as a rope because he knew, fundamentally, the businesses he owned were structurally invincible. He temporarily suspended reality, ignoring the manic panic of the market, only because he had already put in the extreme agonizing research required to know the true intrinsic value.
Right. Suspending reality is a tool to survive emotional distress, but it's absolutely never a substitute for due diligence.
Never.
Which flows perfectly into the final piece of the puzzle here. How do you guarantee those investments are structurally sound before the crash ever happens? You have to aggressively turn every single page.
Obsessive research is literally the only way to find true asymmetric bets. Seth Klarman, one of the greatest value investors alive, he literally named his racehorse, "Read the footnotes," just so the track announcer would be forced to yell it over the loudspeaker.
That is amazing.
Okay.
And it mirrors the ethos of Robert Caro, the legendary biographer, whose documentary is literally titled Turn Every Page. You see this mechanism vividly in Warren Buffett's entire life, too.
Oh, yeah. He is defined by turning the pages that everyone else ignores because they're just too boring.
Right, like when he was just 12 years old, he would hang out at the Axar Bend racetrack in Omaha. He would physically crawl around on the floor collecting discarded betting tickets.
Because he was calculating the odds that a drunk gambler had accidentally thrown away a winning ticket?
Yes, exactly. Then at 24 years old, he's sitting in a room reading the dense, phone book-sized Moody's manuals, just reading it page by tiny print page, hunting for mathematically mispriced companies.
That habit never stopped. Fast forward to his late 80s, and he's sitting in his office reading the massive, incredibly dry Japan Company Handbook.
And that one specific action reading a handbook that almost no one on Wall Street was paying attention to led to one of the most brilliant asymmetric financial bets in modern history.
The Japanese trading companies.
Yep.
Yep.
Buffett finds 5 Japanese trading companies. He decides to invest $5 billion into them. But here's the genius part. He doesn't even use Berkshire Hathaway's cash. He borrows the yen directly in Japan at an incredibly low 0.5% interest rate.
Just 0.5%.
0.5%.
Right. And meanwhile, those 5 trading companies were paying an 8% dividend yield. So structurally, he is completely leveraged, paying virtually nothing in interest while collecting a massive 8% yield on $5 billion.
It's basically free money.
And then over the next few years, the companies doubled their dividends and their stock prices doubled. He essentially turned 5 billion into 10 billion, collecting massive cash flow using other people's money virtually risk-free.
That is the ultimate asymmetric bet. Low risk, high reward, found by turning a page no one else wanted to read.
Yeah.
And Pabrai executed a very similar mechanism with a Canadian steel company called IPSCO.
Oh, the math on this one is beautiful in its simplicity.
Walk us through it.
So the stock was trading on the open market at $40 a share, but Pabrai read the footnotes. He saw they had $15 a share in hard cash just sitting on their balance sheet. Furthermore, they had locked in legally binding contracts guaranteeing they would make $30 a share in profit over the next 2 years.
Okay, so if you do the basic math there, you have $45 in guaranteed cash coming your way for a stock you can buy right now for $40.
Exactly. It's a mathematical certainty. And as a bonus, you get all the actual steel factories, the inventory, and the brand completely for free.
It just perfectly exposes a massive systemic flaw in Wall Street's thinking. Wall Street constantly, repeatedly confuses uncertainty with risk.
They treat them as the exact same metric, and they are completely different.
Here's how I process the difference. Think of Wall Street as a driver who is absolutely terrified of fog. Fog represents uncertainty.
Okay, I like this.
Wall Street hates fog so much that they will actively avoid driving on a perfectly paved, straight, empty, completely safe road simply because it's foggy. But they love a clear, sunny day. They love visibility so much, they will happily drive a bus straight off a cliff at 90 miles an hour, as long as it's perfectly visible and sunny.
That's spot on. Wall Street loves a company like a payroll processor, low uncertainty, highly predictable, sunny earnings, and they will pay an astronomical, dangerous premium for it.
Right.
But they are terrified of a cyclical steel company or an unhedged oil company because the future earnings are foggy. But if the balance sheet is a fortress and the price is deeply discounted, the actual mathematical risk of losing your capital is incredibly low, even if the future path is entirely uncertain.
So the ultimate framework is hunting for low risk combined with high uncertainty.
Because the high uncertainty is the exact mechanism that drives the price down to a bargain in the first place.
Precisely. That fog is where the mispricing lives. Okay, let's pull all these threads together. What we've extracted from Pabrai today is that exceptional capital allocation, and frankly, making exceptional decisions in any area of life, isn't about possessing a massive IQ or complex math algorithms.
No, it is entirely about controlling your behavior. It's treating your major life and financial decisions as if you only have a 20-punch card.
Right.
It's having the intense humility to aggressively clone the best ideas rather than letting your ego demand originality. It's knowing human psychology well enough to build a rope when you fall into a deep well of distress. And, it's having the relentless, boring discipline to turn every single page, read the footnotes, and logically separate true risk from mere uncertainty.
And there's one final brilliant detail from Mohnish Pabrai's talk that I want to leave you with today. When Pabrai visited Warren Buffett's private office in Omaha, he noticed a physical plastic tray sitting right on Buffett's desk. The label taped to the box simply read, "Too hard."
Just too hard.
Yeah. Buffett told him that 99% of the investment pitches, business ideas, and opportunities that cross his desk go straight into that physical box. He doesn't stress over them. He doesn't suffer from the fear of missing out. He just instantly accepts they're outside his tiny circle of competence, and he moves on.
It's just the ultimate filtering mechanism. By instantly discarding the complex, it frees up all his mental bandwidth to focus exclusively on the rare, obvious, slow pitches.
So here is a final thought for you to ponder as you go about your week. What if the ultimate competitive advantage in your life isn't constantly expanding what you know, but having the aggressive discipline to categorize almost everything you encounter as too hard? How much mental energy and time could you reclaim today if you built your own too hard box?
Man, it completely changes how you filter the noise.
It really does. Thanks for joining us on this deep dive. We'll catch you next time.